Welcome to the daily update, where I'll go over the action in the market for Monday, December 4th, and then we'll see how things look for Tuesday, December 5th. We had about a 0.5% decline for the S&P 500, a little bit more than that. Are we starting to come into this period of choppiness in the earlier part of December before we see more positive seasonality going into the end of the year? It looks like that could be happening. Now, in a short and intermediate term basis, we are still overextended to the upside. We really haven't worked off this extreme positive condition yet. It's going to require more sideways action to even declining action to wear that off, but we're still looking positive. But we want to also have respect for the idea that there are times when selling comes into the market and that can take prices lower. Just as kind of a side note, I did make a post on the private Facebook group, and there's not many people that belong to that. But if you would take some time to read through, it's an idea that I have about a new video that I'd like to start doing soon. In the next couple of days, I may end up posting that on the YouTube community channel. So watch for that, and I'll make another announcement about that. So let's go back and talk about what happened. At the open, we had a gap lower open. There were some geopolitical events over the weekend that had to do with Israel. It took place in the Red Sea, and that put some pressure on the futures when they first started trading. That fed over into the European session and then helped the U.S. session to actually open lower. Prices dropped down below S1 at 45.66, and we found support at right around the 45.50 level, kind of a round number for that. Wasn't really a pivot point level. As the day went on, prices climbed back above S1. We got up to 45.70 before falling back down to 45.60. Prices then climbed back up to close just below 45.70. So we were down 0.54%, but volume is still above average. And after the Thanksgiving holiday, we've been seeing volume picking back up. And so that is more encouraging in the idea that there's a lot of participation going on in the market. We are positive still in the short intermediate term, but we're still overextended to the upside. The market's going to be dealing with some inflation reports coming out this week. We have a big report coming out in Tuesday's session. We'll have the employment situation coming out on Friday. And then earnings as they're released by each company. We're keeping an eye on the geopolitical events. Apparently the ceasefire is now over and they're resuming fighting. And Israel has really stepped up the pace. They had been focusing more on the northern part of Gaza. Now they're starting to infiltrate more the southern part of Gaza, which could make this grow even bigger. So let's go make some comments about what happened. The mega caps and the semiconductors were weak. We're seeing that right now. Now, you can take that two different ways. It's been the mega caps that have really led things higher in 2023. And the broad market wasn't really participating. Well, now we're seeing the broad market doing a little bit better and the mega caps, including the semiconductors, showing a bit of weakness. Is it going to continue this way? Now, we could see it as more positive because we're seeing a broader participation. But at the same time, we can have a good day for the broad market, but the major indexes still decline. Small and mid caps did advance, so we're seeing a little bit of a follow through there. We want to know, can this continue? Bitcoin is actually seeing a little bit of life right now. It climbed back above 40,000, actually hit the 41,000 level over the weekend and then pulled back from that area. Oil did close down at $73.04. We're still wondering, especially when things get a little crazy in the Middle East, that can have a real impact on oil prices, but we still closed down. On a short-term basis, we still have the short-term ADX, which measures our trend situation. That is still extreme. That's still above 40. The advanced decline ratio for the short-term, that's the blue line. The 20-period exponential moving average, the Williams percent R, the stochastics, the PMO oscillator, and the slope oscillator, which is still extreme, but now it's coming down and it's below its moving average. And believe it or not, we already have one oversold indicator, the Stoch RSI. You see how touchy these things can be? So we were extreme positive and we immediately shot down to being extreme negative. Intermediate term, we still have the 50-period exponential moving average study. The NYSE McClellan oscillator, that's dropped off, but the S&P McClellan oscillator is still on the list. the PMO studies, the TTM squeeze, the NASDAQ 100 bullish percent index, the advanced decline ratio based on 19 periods, and then the new high, new low study based on 10 periods for the S&P. The current scenarios is not really changing all that much. It's what we've been dealing with for the last few months, that the Fed is keeping rates higher for longer. If we see strong economic reports, they may have to entertain the idea of raising rates. If they're really weak economic reports, then at first that may be positive for the market. But if that leads to a deflationary type of a situation, that could end up being negative. We're keeping an eye on Israel, oil, and then earnings. The dollar was down and interest rates were up. And the fact that interest rates were up produced some headwinds for stocks. The 10 to the 2 and the 10 to the 3 month are still inverted yield curves. Sentiment, we actually ticked up. We closed at 67 on Friday. We ticked up to 68 after Monday's session. Our trend is still positive. And the indicator that we focus on the most is the intermediate term ADX. We're above the moving average. It's going up. That means that it's a strong trend. And we're above 20, also suggesting that we're in a trending environment. Because of the down day, our bias is negative. That's usually just one day, but our momentum still continues to be positive. Economic reports, it was pretty light. We just had factory orders that came out. They were down 3.6%, more than the minus 2.6% they had expected. Last time they were up 2.3%. So here's some charts. Here are the factory orders year over year, showing that we are declining and actually going negative. So this is showing a bit more weakness economically. Durable goods orders actually shot up, and they are looking more positive on a year over year basis. Non-durable goods orders are starting to decline and below zero. And non-defense capital goods, when you take out aircraft, still above zero, but did decline in the latest reading. We closed at 4.29% for the 10-year yield. We're getting closer to that 4.02%, but we're still above that. According to RenMac, when we're at this level, that's when it can feed into corporate profits and actually be more negative than positive. Here's our intraday chart where we gapped lower. Now, because of the lighter days that we saw earlier on this chart, this looks a lot bigger than it really was. But we came down. We opened at about S1. We shot down here to the 45.50 level. Then we bounced back up, actually got a little bit above S1, came up to the 45.70 level. It's interesting how these round numbers are coming into play. Fell back just a little bit to the 45.60 level, and then saw a little bit of buying going into the close. So if you just looked at this chart by itself, it's actually kind of positive. We opened and closed at about the same point, but we ended up setting the high right near the close and closed right back at the daily high. There were three tests so far of this price level. Intraday, though, doesn't look quite as positive. Futures started to go negative before the market opened. Then we saw the cash session, and we're down a little bit more in the initial overnight session. We are still seeing where value, that's the red line, is outperforming growth, even though both were negative. And we're looking at the ratio. We're seeing more of a gradual decline now. As the market was going up, this ratio was going down. That's not really what we like to see. And we were, after having a really negative open, we pretty much went flat in the rest of the session for the S&P 500 growth to value ratio. The end of day charts, we were down more with large cap growth than we were with large cap value, even though both were down. For the mid caps, growth was up, but up less than value, and small cap growth also underperformed small cap value. And we're seeing this ratio starting to really go off. We're seeing a bit of a negative divergence here. As the S&P has been going up, we're seeing the growth to value ratio going down. That's a bit of a warning sign for us. Then when we look at the discretionary equal weight ETF and the staples equal weight ETF, they're both showing a little bit of strength now. So we look at the ratio down at the bottom where discretionary is outperforming staples right now. So that's still positive. And this is in my opinion, more of an accurate way to measure this because everything inside this ETF is treated the same. It's not a weighted ETF. Keeping an eye on our trend, we do have the ADX above the moving average. The green line's on top, even though it is declining, so we're still positive, and we're not getting too close yet anyway to that 40 level, where we're now above 40 with our short-term ADX. We're above the moving average. We haven't really started to roll over yet. The green line is still on top. So our trend is still positive and we're still in a trending environment, but we're starting to get pretty extreme with the short-term indicator, which will often precede the intermediate term indicator. We are seeing a nice little pickup in volume. It dropped off a little bit, but we're starting to get above average on a more consistent basis. Sentiment, we're wondering, are we into this choppy part here, which historically has happened from 1990 to 2022 before we see the VIX continue to decline? That's usually when stocks are going up. The Ulcer Index really hasn't been moving all that much, showing that there's not a lot of fear in the market. Keeping an eye on the VIX, we ticked up just a little bit with the line chart as well as the bar chart because we spent most of the day going down, and then this started to repair itself as we were coming back up. The VIX of the VIX is also picking up a little bit of steam. It's coming back up to the moving average on the bar chart, but we still close down below the moving averages on the line chart. The VIX to VVIX ratio continues to decline. That's longer term positive. The VIX to the 3-month average of the VIX is also declining. That's longer term positive. The VIX to move ratio is still very, very low, showing that there's not a lot of fear when it comes to stocks. And this is finally updated here. Here's the 1-day equity put call ratio chart where it ticked up just a little bit. Now, I wasn't able to show this in Monday's video because even a day and a half later, this chart still had not updated yet. We have been declining with the equity put call ratio as the market had been going up. So when we look at our 5-period simple moving average, we are declining. We spiked up here. We did spike up before, fell, and then only to go back up. Now we're starting to come back down. This is getting pretty choppy now because we're seeing a lot of hedging going, especially ahead of a holiday or ahead of a weekend. And with the geopolitical things happening, folks just want to be hedged in case anything really crazy happens or crazier. Then here's a long-term look at that same chart with the 5-period simple moving average where we did spike up and now we're starting to come back down. This could be more short to intermediate term positive. But we also want to keep an eye on this. If we get down to this blue area, this green area down here, that means that maybe we're going up with the stocks and down too quickly with the equity put call ratio. Longer term, the 253-period moving average is now turning down. That's also long-term positive. We ticked up just a little bit with this fear gauge, but overall we have been declining, again, showing there's not a lot of fear. This other fear gauge was down in Monday's session and has been declining overall. Not a lot of fear there. We saw a little bit of a pullback with our risk on to risk off ratio, but overall it has been bouncing up. But we want to see this continue to go up where it really still is more in a downtrend, meaning that folks are favoring being risk off. That means selling stocks rather than risk on where they buy stocks. Our advanced decline line studies held up fairly well based on price, and we're well above the moving average. We actually turned down just a little bit based on volume. New highs. We're not seeing a real expansion of the new lows, even though the new highs fell off. So when you just look at the green and the red, that's looking more positive, but it's causing our 5-period moving average to flatten out, but our 10-period is now starting to turn back up. The advanced decline ratio, the blue line did come down a little bit, but is still extreme positive. The red line is still positive. Accumulation distribution is showing some strength here. So we're above an advancing moving average. The chicken money flow is coming back up just a little bit. The red line, which is the moving average, is trying to turn back up. That's positive. We declined a little bit with the NYSE cumulative advanced decline line, but we're still above this trend line. And we're showing a bit of an improvement here with the NYSE advanced decline line, the regular version. And we're still breaking out above both of the moving averages with our other measure of the NYSE advanced decline line. We are breaking out when we look at common stock for the NYSE based on price and volume. So now these are confirming each other. Our advanced decline line studies seeing a little bit of an improvement with the NYSE common stock. We were pretty much flat with the S&P, are showing some improvement with the mid caps and the small caps. And if we hit the normal January effect, that usually kicks into gear about the middle part of December. And that could be very advantageous for small caps, which may bleed over into mid caps. Our short-term charts, we're still hanging out okay up here where we were going up, and now we've been pretty much chopping sideways. We're wondering, we hit that 4,600 level in Friday's session, and that seems to be overhead resistance for right now. If we do have an up day, we want to get above 4,600 and then close above that level. On the bottom, we are still above the moving average with volume. We're still extreme with our 20-period exponential moving average and our 50-period exponential moving average, where we continue to advance with the 200-period moving average. Here's the Stochc RSI, where we were just camped up in extreme positive territory. We go down 0.5%, and boom, we're already extreme negative. The Williams percent R is coming down, but it's just barely, it's a little bit below the extreme positive territory right now. The force index is actually declining a little bit below the midpoint, but we're still looking positive since it's green and above zero. Where we're coming down just a little bit with the short-term stochastics, we're flat to slightly declining with the intermediate short-term. We're still flat with the long short-term stochastics. We're coming down to the border between the +2 and +3 standard deviation. We've been camped up above or at this +3 area, suggesting that the market was overextended. If we can fall back into the +2 area or just stay where we're at and have these lines catch up, that would turn things a little more positive. Intermediate term, the balance of power is still above the dashed line, and it was flat in Monday's session, but it's still positive. We're still positive with the go, no-go system with the darker blue bars. We're chopping sideways with our highest high value, but the midpoint continues to advance. The TTM squeeze starting to come down and just about ready to go below this black line that I put here, so there's nothing magical about it. The fact that we're a darker shade of blue is slightly negative because if it turns the lighter shade of blue, that means we're going up. The darker shade means we're going down. There's a long-term look at that. If we can get below this, this would no longer be extreme. Ease of movement is starting to decline, but we're still above zero. And the Erin is pretty much flat right now. We have the green on top, that's buyers, where the red line is on the bottom, that's sellers. You could make a case that we're getting rather extreme with this oscillator. And we came down just a little bit with the S&P 500 McClellan oscillator, but we're still looking extreme positive. But because we're above zero, the summation index based on price is advancing, and we're starting to come back up to this previous high here with the summation index based on volume. We're still going up with the NYSE summation index based on price and volume. So broader, when we look at a broader measure of things, we are looking more positive. The Swenlin trading oscillator based on price and volume are now turning back up. That's positive. The PMO is starting to get extreme, but it's still positive. And when we look at it based on price and volume, we continue to be positive. We're just ready to come down from the PMOs that are rising after being extreme positive. We're flat, but still extreme with the buy signals. We're starting to get extreme now with the PMOs that are above zero. We continue to be neutral with the Elder's Impulse system for the S&P. We continue to be positive with the parabolic SAR. The slope oscillator, it's still positive, but we're coming down and dropping below the moving average. So this is starting to show potentially some weakness. The MACD is still positive, but rolling over as well. That's intermediate term. So when we look at all of our oscillators, coming down with the slope oscillator, getting extreme with the TSI, and not really rolling over yet, where the MACD is starting to flatten out. The PMO is still looking positive, where we're flattening out with the PPO. We're getting extreme with the tricks and KST, and now the KST looks like it's just beginning to roll over. The Sean trend meter has dropped below the red line, so it's no longer extreme positive, but we're still above all of the moving averages in our moving average tree. And the bullish percent index continues to go up. This is positive. If we tick up to 70 or above, then we're going to start to get into an extreme positive range. The NYSE bullish percent index is above 50 and advancing. That's still positive. The NASDAQ 100 bullish percent index is still extreme positive, and we're pretty much flat. The Chaikin oscillator is advancing and above zero. That's positive. The money flow is declining, but still above 50. The ultimate oscillator ticked down, but is still above 50. The vortex, we're seeing the green line coming down, the red line going up, but the green line is still on top. The RSI 14 period is no longer extreme positive. We're just barely extreme positive with the 9-period RSI. On balance volume ticked down just a little bit, but it's still above an advancing moving average. We were just a little bit better with our 200-period moving average study for the S&P, and we ticked down just a little bit with the 50-period moving average study. The copy curve has now generated a sell signal, and longer term, it's starting to roll over after giving us a pretty high reading. I don't have any Fibonacci charts. We're still in no man's land, but we continue to be above this shorter-term high that we set back in August. We've been chopping sideways for right now. Now, this bar looks okay, where we opened and then went down, made a low, and then ended up closing a little bit higher than that. That's kind of positive, even though it ended up being a down day. We're wondering at some point, is the S&P going to go back and test the July 31st high and be able to close above that? But on a more of a trending basis, the Heikin Ashi is still positive, even though we're seeing the beginning of a black candle here. We're turning down, but we're still positive with the Kegi. It's black, that's positive. The fact that it's pointing down is a negative bias. But the Renko continues to be positive, and the 3-line break chart is also positive. We're not seeing any changes here with the Zohorchak method. We came down to this -6. We'll have to see. Are we going to bounce back up and show some improvement? Or if we see more weakness at some point, is this going to come down and give us a full-blown sell signal? Our different indexes, we are seeing a bit of an improvement with the equal weight as the S&P has been going sideways. And this ratio is really coming down, which you could say, oh, no, that's negative. The mega caps are falling apart. Or, oh, that's positive because we're seeing other stocks other than the mega caps start to participate. With the Dow, we were down just a little bit. We were up with the transports. This could be a little bit encouraging, and we ticked down just a little bit with the utilities, but the transports continue to underperform the Dow. The red line is underneath the black line. And we're chopping around a little bit here with the Dow to transports ratio, but when this goes down, that means the transports are outperforming. And we're seeing a couple of days now of an improvement with the transports to S&P 500 ratio. To turn back positive, we want to see this ratio continue to go up. The Dow, after having a really nice run up, was down, but not by very much. This is still looking fairly positive. The diamonds continue to be positive for the Elders Impulse system. And we were down almost 1% with the NASDAQ. We're right about at this pivot point now. So even though we fell below that, we were able to recapture that on Monday. We're coming down a little bit here on an intraday basis. So we're watching the 61.8% retracement level. We're still kind of far away from that. If we see more weakness, we'll be watching to see if this level will provide support. And the NASDAQ 100 was also down about 1%, but we were able to get just almost back up to this pivot point here. The Elders Impulse system still remains neutral for the QQQs. But on a momentum basis, we are seeing some weakness. The PPO for the NASDAQ 100 is now crossing below its moving average. It's still above zero, but the fact that we're seeing this really trailing off could be negative. The small caps are continuing to show some more strength. They were up 1 1/3% and actually closed slightly above the R1 level. And when we look at the Russell 2000, we're coming right back up to this green line here. We closed just about on that. At one point, this acted as support. As we were coming back up, it acted as resistance. I would count this as resistance because we're coming up from it from below. Can we get above that? That would really help things to improve. But we're looking extreme positive with the RSI. On a momentum basis, we're still looking positive, even though the longer-term trend continues to be negative. And we continue to be positive, though, with the Elders Impulse system for the small caps. The mid caps also, we're able to see a nice little bounce here and close above this R1 level. And we continue to be positive with the Elders Impulse system for the mid caps. We were down just a little bit with the financial sector, but it's had a pretty good run lately, and we're seeing a recent golden cross. The micro caps also saw a little bit more buying enthusiasm in Monday's session, and we're getting further away from this 100 level. The FANG index, though, was down 1 1/3% after having a really nice run up, but it's still in a longer term uptrend. And we're still having a difficult time with this all-time high here. This is acting as overhead resistance, and we've been pulling back down from that. The dollar was down slightly, but it's still in a longer-term uptrend. With bonds, we were up with the 10-year yield. We were down with the 10-year based on price. And this is still acting crazy. The 1 month minus the 3 month, even though it's coming down a little bit, we're still getting a positive answer at 0.09. Then an update of our possible positive scenarios. We're seeing the Qs starting to underperform the S&P. We're dropping below the moving average. But with the discretionary, this could be encouraging. We're actually turning up a little bit above the moving average, but large cap growth is underperforming large cap value. So our other growth to value ratios showing some weakness with the large caps, coming back down to the moving average with the mid caps, and still a little bit below the moving average with the small caps. We're still looking extreme positive here with our 10-day average of the S&P 500 highs minus the lows. We've spent 4 or 5 days up in this area for right now. That could suggest good momentum instead of hitting this and then immediately turning and going in the other direction. We're still above zero with our 5-period moving average of the highs minus the lows when we look at the Amex, NASDAQ, and NYSE. That's more broad market participation. In our 50-period new highs, new lows study, we continue to be above zero and advanced. That's looking more positive because the red line, which is the moving average, is getting further above zero. The 2-year Treasury yield, have we spiked and are starting to come down now? That often gives short to intermediate term support to the S&P, even though we had a down day on Monday. In the Staples S&P 500 ratio, it's been chopping around a little bit, and it was up a little bit in Monday's session. We want to see this decline. That's typically when the S&P is doing better. And when we look at our 19-day exponential moving average, the advanced decline ratio, we're still extreme based on price. We came down just a little bit and not extreme based on volume, at least yet. But this is still positive. I haven't received the December statistics yet from Tom Bowley. So what's our outlook for Tuesday? We are still dealing with earnings. We're dealing with geopolitical events. I added the Red Sea there on the list. Our technicals are still positive, but we're still overbought. It's been over a week since I've had to change this. We're wondering, is weakness starting to come a little bit stronger into the picture? We will get the S&P Global. Okay, that's wrong. No, that is right. The S&P Global U.S. Services PMI, the final reading. The big one is going to be the ISM non-manufacturing PMI. And then the JOLTS job openings. This is kind of employment situation week because we're going to get the big report later on. And then we want to keep an eye on all the different geopolitical events. Here's the economic calendar where we do have a lot of reports coming out, but the big one is going to be slated for Friday. Seasonality, looking at December 5th, where we're pretty positive seasonally. We're positive with the Dow and NASDAQ, where we're neutral to positive with the S&P 500. And we're just looking at this ratio between the Russell 2000, which are the small caps, and the Russell 1000, which are large caps. And we're in that period of time where the small caps tend to outperform the large caps. We'll be on the 3rd trading day of the month, where we do see a little bit of an improvement here when we look at the green dashed line for a pre-election year. And we're also looking at the Carson chart here, where we might see a little bit of a bounce, but then we see some more weakness. Where we really see some more strength is later on in the month of December, at least historically. And then I added this from the weekly video, where Monday and Friday tend to be the most positive days, where Tuesday and Wednesday, with Wednesday being down the most in 2023, Thursday can be positive, but is not as strong, not as strong as Monday and Friday. And we're also keeping an eye on when we have a sitting president who's running for re-election, are we going to come into this time where we see a little bit of a decline here with the green line? We also see a little bit of a weakness here with this seasonal chart. This might be the time now that we're coming into where we see some weakness right around here. And we also tend to see some weakness when we compare election years with non-election years. And this is the weakness that we see at the beginning part of December based on the Carson research. And are we seeing a little bit of choppiness? We don't really get much of the seasonal weakness with this chart, but it does come a little bit later. Are we coming into this period now before we see more positive seasonality? Then looking at the Stock Traders Almanac statistics, where we tend to look fairly positive going forward. We're not really seeing any real noticeable declines. We also see a little bit of a pullback here with the green line. That's the S&P. So there might be some more weakness there. So our scenarios, not going with the down one, even though weakness may be starting to come into the picture. All of our charts are still positive, even though we continue to be overbought. We're not going with the sideways trend because our ADX is telling us in the short and intermediate term that we are in fact trending. The warning signs, we're keeping an eye on this risk on to risk off ratio now. It pulled back a little bit on Monday, but it did see a couple of good days last week. We want to see that continue to go up, but for right now, the bigger picture is it's still declining. Our momentum oscillators are giving us a little bit of a concern now. They're positive, but they're starting to roll over. The copy curve has generated a buy signal. The Russell, small caps, and mid caps are still in downtrends, even though they've seen a couple of good days now. The positive signs, the daily special K chart is positive, and since I was able to update this, our equity put call ratio based on 5 periods and 253 periods, those are both going down, and that is positive for the market. Our oscillators are still positive, but as I said, starting to show some signs of weakness. The parabolic SAR and the vortex charts are still positive, even though the vortex has been coming down with the green line. The bullish percent index, that's still looking kind of strong and not necessarily extreme positive. Small and mid cap growth has been chopping sideways, but it's still longer term positive. The financial sector pulled back on Monday, but has still seen a pretty good run as of late. And then our 50-period exponential moving average is looking more positive as we go further above zero. So our conclusion, we're positive but overbought. Is there weakness starting to come into the picture? We can say that same thing in the short and intermediate term, but we're still positive in the long term. Thank you. I really hope you found this helpful. Have a really good day, and I will talk to you in the next video.